Hello class, welcome to this lecture on principles of microeconomics regarding surplus, taxes, and intervention. This will be an extension off of what we discussed in last lecture, which was demand and supply and market equilibrium and analyzing equilibrium and how it changes when demand and supply changes. A roadmap for this lecture starts with discussing these measurements of economic welfare. So we'll talk about economic efficiency, allocative efficiency like we did in the first lecture of the course, and then build off of that by discussing what consumer surplus is, what producer surplus is, and then we'll talk about government intervention in three ways. The first way is price floors, the second way is price ceilings, and the last way is through taxes. And we'll see how these different government interventions can affect efficiency and why they are used in this efficiency versus equity context. So, I'll start this lecture by discussing how we can identify the benefit that exists in a market. So, we discussed in the last lecture market equilibrium, and we were trying to figure out, okay, what is the most efficient way to produce? Where do we produce? How many units do we produce? How much do we sell it for? And why is that the best spot? So we talked about this consequence of surplus or excess. So this is a different concept of surplus. Before, when we meant surplus, that meant there was too much of it available. We were wasting key resources, finite, limited resources on overproduction of goods and services that were being charged too high of prices, and there wasn't requisite quantity demanded to meet that quantity supplied. We also talked about shortages, where if there's too low of a price, then there's no incentive for the firm to produce the level that is demanded by the market, and as a result, there are people that are left empty-handed. And we discussed how the allocatively efficient solution is to produce where quantity supplied is equal to quantity demanded at that market equilibrium point. However, how do we know that's true? Well, economic surplus is our way of measuring welfare for the economy by the clearing of the market or the equilibrium of the market. And so economic surplus basically is the overall benefit, the overall welfare that we can measure from the efficiency that's created by the market. And that can be broken into two types of surplus: consumer surplus and producer surplus. Consumer surplus is benefit that is shared by the people purchasing the product, the consumers, and producer surplus is the welfare that is captured by firms and businesses. And so what we will show is that at that market equilibrium point, that efficient solution, that allocatively efficient solution, that economic surplus is actually maximized at that point. So that shows that that's why we would produce at that point. So we'll break economic surplus into two categories: consumer surplus and producer surplus. And we'll start by talking about consumer surplus. So consumer surplus is the difference between the highest price a consumer is willing and able to pay for a good or service and the price they actually pay for it. So the reality is that if you're on eBay or you're at a store and there's a product that you really want, there's a number in your head and a price that you probably would be willing to pay that is different than the price that's actually being charged. If the maximum price you're willing to pay is below the price that's being charged by the firm, then you're not going to buy it. You just aren't going to actually execute that trade. However, there are circumstances in which the amount you're willing to pay is actually higher than the price that's actually being charged by the firm. So you buy it, but you get some extra surplus as a result of the price being lower than you were willing and able to pay. Because now you can take that extra money and buy something else with it. You were perfectly happy with spending all of the money that you had allocated and devoted to that product on that product, but now you're getting it for a lower price and now have some leftover surplus to spend on other key finite things that you would like to purchase, things that you need, things that you want with that limited resource that you now have a little bit of extra to spend. So what we can do is we can actually visualize consumer surplus by its definition. It's the difference between the highest price a consumer is willing and able to pay and the price they actually pay for it. So if you want to visualize that, it's actually just going to be the area below the demand curve and above the market equilibrium price, bound by the y-axis, which is the price axis on the graph. Now, we can't see that in this slide quite yet, because what this is doing is it's basically doing a bunch of Riemann sums that are just calculating specific levels of consumer surplus for individuals. So, in the first example in A, we have 3 or 4 people that are interested in purchasing chai lattes, chai tea lattes. So originally we have a market price of $3.50. At $3.50, Teresa, Tom, and Terry are all going to buy chai teas. Why is that the case? Because Teresa was willing and able to pay $6 for that chai tea. But is she going to pay $6? She's not going to pay $6. She's going to actually pay $3.50. And because she's only paying $3.50, she now has $2.50 she was willing to part with to get the same chai tea that she now can allocate to something else. In fact, she could almost buy a second one. In fact, she could buy a second one if they lowered the price to $3, which they'll do in B, but we'll talk about in a second. Tom is willing and able to pay $5 for that chai tea. He's still only going to have to pay $3.50, so he's going to get the chai tea, and he's going to have an additional $1.50 to spend on other goods and services. Terry is willing to pay $4 for the chai tea. And originally, she was going to pay $3.50 for it. $4 for it. Now she only has to pay $3.50 for it, so she gets 50 cents of surplus herself. Tim, on the other hand, is only willing and able to pay $3 for the chai tea. So he doesn't spend any money, but he also doesn't get the product that he wanted to buy because the price is too high from his willingness and ability to pay. So as a result, in example A, the consumer surplus is the sum of the surplus of all individuals that purchase the product. For Teresa, it's $3, or it's actually $2.50. For Tom, it's $1.50. For Terry, it's 50 cents. When you add that all together, $2.50 plus $1.50 plus 50 cents, that is $4.50 in consumer surplus. Not a lot, but it's better than just paying the maximum price you're willing and able to pay and not having extra money to spend on other resources. Now, if we look at it with a market price of $3, the amount of consumer surplus is going to increase. So Teresa's willingness to pay hasn't changed, but because the price is lowered, she's now getting the tea for $3 when she was willing to pay $6, so she gets $3 of consumer surplus. We don't necessarily know if she would pay $6 for the second tea, or what her willingness and ability to pay would be for the second tea, so we can only speculate that she bought one. So when she bought that one, she gets $3 of consumer surplus. Tom was willing to pay $5, now that's $3, he gets $2 of consumer surplus. Terry was willing to pay $4, now is only having to pay $3, so she gets $1 of economic surplus or consumer surplus. Tim was willing to pay $3, so now he's going to buy the chai tea at $3. He's not going to get any consumer surplus because he's basically paying the maximum price he's willing to pay, but at least he gets his chai tea now. And overall, because that price was lowered, our economic surplus actually increased by $1.50 from $4.50 to $6 because of the fact that Teresa, Tom, and Terry respectively all got an extra 50 cents in consumer surplus. Well, it's still economic surplus. It's part of it, but specifically, they got an extra 50 cents per person for consumer surplus. So that's how consumer surplus is calculated. Now we can look at it from the perspective of the firm. The firm can also benefit by market equilibrium because there could be a situation where the firm was willing to sell the product at a lower price than they actually ended up selling it for. And so that firm is actually getting additional revenue that they otherwise would not have gotten if they only charged the lowest price they were willing to accept. So the definition of producer surplus is the difference between the lowest price a firm is willing and able to accept for a good or service and the price they actually receive for it. So again, when we visualize this on the graph, I'm going to give you a kind of a Riemann sum piecewise type of graph that is not exactly what the supply curve and the demand curve will look like on the graph when we do it, but I will show you how it's calculated when we have just a regular old market equilibrium graph. But for now, we'll just show it to you kind of item by item like we did with consumer surplus. So this one actually allows for you to visualize kind of how consumer surplus, or excuse me, producer surplus is going to be calculated, but we still have the same kind of piecewise function that we can show. So again, now this is Heavenly Tea selling chai tea to customers. So the market price is $2 for this Heavenly Tea, but for the first cup, the firm was willing and able to sell it for $1.25. Now, does the consumer know that? No, but the firm knows that, and because they got an extra 75 cents out of it, that's now extra revenue in their pocket that they otherwise would have not had if they just charged the $1.25, which was their bare minimum price they were willing to accept. When we move to the second cup, they were willing and able to sell it at $1.50, but now they're selling it for $2. So as a result, they're getting an extra 50 cents of producer surplus, in addition to the 75 cents from the first cup. When we get to the third cup, the firm was willing to sell that at $1.75. They ended up selling it for $2. And so as a result, there's 25 cents of producer surplus at that point. So overall, when you add that all together, the firm now has an extra $1.50 in revenue that they otherwise would not have had if they weren't at the market price. And notice that they're not willing to produce a fourth cup and sell a fourth cup because their minimum price they were willing to accept for that was $2.25. So they'll only sell 3 cups of tea. Not a lot of tea, probably not enough to have a brick and mortar operation or to make really any money and be successful, but it's an example. Now, if we took all of the tea purveyors in Cheyenne or Muskegon, Michigan, or Portland, Oregon, or Cleveland, Ohio, or Ann Arbor, Michigan, or Denver, Colorado, and all of these kind of purveyors in all of these cities and towns, if we aggregate those all and have a market price, then we see what the supply curve is from the aggregation of all those firms, but we also see kind of how many units would be produced at that $2, and also what the economic surplus or producer surplus is from that supply curve and that market price being charged. Look at all of the teas that would have been sold for, say, 50 cents or 75 cents or $1.20 or $1.40 that are all being sold for $2. All of that is extra revenue for all of those tea purveyors. So that's benefit that's provided by the system. So notice at the same time, so you think that like, okay, maybe they're ripping off consumers if the fact that they're making a bunch of extra revenue. But at the same time, the firm is making extra revenue, the household, the demanders, the consumers are also getting additional savings. So by virtue of being at a market equilibrium, both parties benefit, maybe not equally, but they both benefit, and at that market equilibrium point, we will maximize overall economic surplus versus any other combination or production level. So now we have the original market graph that we've been analyzing throughout that entire lecture that we had on supply and demand. We're now going to calculate consumer and producer surplus within the context of that example. So in order to do this, we need to extend out the supply and the demand curves to their respective intercepts. That way we have a bound area in a bound shape so we can actually calculate the area of a shape. Because the simplest way to do this within the context of a market is to calculate the area of some triangles. So the definition of consumer surplus is the difference between the highest price a consumer is willing and able to pay, which we can just treat as the demand curve, and the price they actually pay for the product. So the highest price that the consumer is willing and able to pay is going to be measured by the demand curve, and then the price they actually pay is going to be determined by this market equilibrium price right here. And so if you take the demand curve, the y-axis or the price axis, and the price they actually pay, and you fill this in, this area is actually going to be our consumer surplus. For firms, producer surplus is the difference between the lowest price a firm is willing and able to accept and the price they actually receive. So that area is going to be bound by the price axis, the supply curve, and the market equilibrium price. So this little yellow triangle here is going to be producer surplus. So how do we calculate this area? How do we calculate the actual amount of consumer and producer surplus? Well, we're going to have the area of a triangle there, and so just as a recap, the area of a triangle is half the base times the height. So if we're calculating this at market equilibrium, the base is going to be the same. We're sharing the same bottom of the triangle, and that's just going to be the difference between the 0 point on the quantity axis and Q star. So Q star minus 0 is just Q star. So Q star, our equilibrium quantity, is going to be that variable for B. So 1/2 times the Q star. And now I need to figure out what the height is. Now, I intentionally extended out those intercepts, or excuse me, those supply and demand curves, so that way the intercept would be known. And that's important because that allows for us to calculate the height of the triangle. For consumer surplus, the highest point of that height is going to be that intercept, that point where quantity demanded becomes 0. So the price that corresponds with that is going to be the top part of the height. But then you have to subtract the bottom part, which is just going to be the price that's actually charged. In this case, it'll be the equilibrium price. So the difference between the intercept and P star times Q star times 1/2 is going to be the exact dollar amount of consumer surplus. For producer surplus, the top part of that height is going to actually be the price that's charged, which is going to be P star at the point of equilibrium. And then you're going to subtract the intercept for the supply. So that means the point where quantity supplied is equal to 0, where that supply curve intersects the price axis, or the y-intercept basically. So for that one, it's going to be P star minus the price where quantity supplied is equal to 0 times Q star times 1/2, and that'll be your producer surplus. So if we plug those numbers in action, so I'll just kind of quickly redraw the graph for you. So we had the supply curve going through the intercept at 0, and then we had the demand curve going through the intercept at 1200. Equilibrium price was 600, and equilibrium quantity was 1.5 million. So now that we have those numbers, so we have P star, we have Q star, we have our intercepts, we can just plug those numbers in. So the point where quantity demand is equal to 0 is $1,200, P star is 600, equilibrium quantity or Q star is 1.5 million. So if you just plug those numbers in and solve for the area of a triangle, you end up getting $450 million. So that's the economic surplus, or excuse me, the consumer surplus. So the area of this triangle is equal to $450 billion. Now the intercept where price where quantity supplied is equal to 0 is at $0. P star is at 600. Q star is still 1.5 million. So when you plug in all those numbers, the area of this triangle right here is going to be 450 million as well. Are they always going to be the same? No, they're not. In fact, oftentimes they're not the same. But it helps give you kind of context to show you kind of that there is benefit that's being provided by this market system being efficient. Any other point, we wouldn't get as much as $900 million in total economic surplus. So economic surplus is just the sum of consumer surplus and producer surplus. So we end up with $900 million in this example. So that's how we maximize overall economic surplus. We have to operate at market equilibrium. If we're not at market equilibrium, we're not going to maximize our overall economic surplus, which is the sum of consumer surplus and producer surplus. Consumer surplus and producer surplus in the last example were the same, but it doesn't necessarily mean they will be in all cases. Now, let's turn our attention to talking about how the government can intervene. There are 3 ways in which they can intervene that we'll talk about. The first one is price ceiling, which is a legally set maximum price that a firm can charge for a good or service. So the typical example is a rent ceiling. So our rent controls. So you might have heard about them in New York City. The state of Oregon just passed rent controls for the entire state, effective I believe it was either July of 2019 or January 1st of 2020. But those are effective ways of price ceilings. Now they might enforce them in a different way than we're going to show in this example, but they are examples of price ceilings. Price floor is a legally enforced minimum price that could be charged. This is usually enforced on alcohol and tobacco sales. So if you've ever been to a gas station and it says that they're charging statewide minimum pricing, it's because there's a price floor set for that good or service, for that beer, for those cigarettes, for that wine, etc. An example of this is I was living in Ohio at the time, and there was a local grocery store that was going out of business. It had been part of the community for 40 years. And people were really upset that it was closing. However, I went in there to check it out because they were kind of clearancing off everything. And I went in there about a week before they closed, and really all that was left was the shelving, and some of it had actually been sold because other businesses were going to take an opportunity and buy kitchen sinks and coolers and shelves and things like that. But anyways, the only thing that was left besides shelving was wine. It was dusty old wine that they found from the back of the store in the warehouse for probably been there forever, but they couldn't charge less than the state minimum price, so no one ever ended up buying it, so it was the only thing left. And so that's kind of how price floors are implemented. Taxes, on the other hand, we're all familiar with them. There's flat taxes, ad valorem taxes, progressive taxes, regressive taxes, sin taxes, tons of taxes, death and taxes, income taxes, property taxes, so many taxes. So we'll kind of talk about how taxes are implemented and kind of how they are distributed in terms of inefficiencies. In fact, we'll talk about when we talk about externalities, the taxes are actually probably something that's important and necessary to implement to curtail issues that we see that need to be corrected from external costs. So let's do an example with a price ceiling. So, Fort Collins, Colorado is a hot rental market. And so a lot of this has to do with figuring out, okay, first off, we have a market here. What is the equilibrium? So I've given you 2 equations to calculate that market equilibrium to see, okay, if the city of Fort Collins implements a cap on the rent control, they can't charge more than $2,000 a month for rentals in Fort Collins, what would happen to the available rentals? Well, the answer is that if the ceiling is above equilibrium, nothing changes. There won't be an issue. Market equilibrium will be where things stabilize at. So even if Fort Collins is like 3,000 is the cap, 2,000 is the cap, if market equilibrium is $1,700, then that's how much is going to get charged, and the market and the government intervention doesn't really make any changes. There's no inefficiencies created. Nothing really happens. However, if the government implements a rent control that is below market equilibrium, then that will prevent us from reaching equilibrium, and there will be a loss in economic surplus and a loss in quantity of homes supplied and apartments supplied. So, in order for us to analyze that, we need to figure out equilibrium in this context. So, I've given you two equations. In order to find the market equilibrium price and quantity, you need to set those two equations equal to each other. So we have 10p plus 30,000 equal to 10p minus 4,000. So if we take the 10p and add it to the other side, and we take the 4,000, add it to each side, we end up with 34,020p. So if we divide 34,000 divided by 20, we end up with $1,700. So $1,700 is the market equilibrium rent in Fort Collins, Colorado. We plug that 1,700 into the original equations. We can either do it here or we can do it here, and we get that 13,000 apartments are available for rent in Fort Collins based on this market equilibrium price of $1,700. So, with that information, we now know that if we charge $2,000 a month as our cap, nothing will happen in the first example. If we impose a rent ceiling of $1,200 a month, then something will happen. What is that something? Well, we'll find out. So here's the example. So here we have our market equilibrium of $1,700 and 13,000 apartments. But if we implement a price ceiling of $1,200, what I like to do is draw a hard line through here. So this is $1,200. This is our price ceiling. We can't go above it. So as a result, we can't achieve equilibrium. The question now is, how many apartments will now be available? Well, before, remember, when we're below equilibrium, we have a shortage situation where basically the quantity demanded is going to be greater than the quantity supplied. So the actual amount of transactions that occur is always dictated by the smaller quantity. It's not dictated by the larger quantity. So the reality is that the new amount of rentals is going to be here. What is this number? We don't know. So as I mentioned before, equilibrium price is $1,700 a month for a rental. The equilibrium quantity is 13,000. We've determined that nothing will happen at 2,000, but something will happen at 1,200. If we take our original equation, so we know that quantity supplied is going to dictate the new level of quantity at $1,200. Since we know that, we can take our quantity supplied equation from before, which was 10p. It's a 10. It's a 0, I promise. Minus 4,000. Plug in 1,200 here, so we get 10 times 1,200 minus 4,000. So we end up with 12,000 minus 4,000. And so as a result of the price ceiling, only 8,000 units are going to be available, which I'm going to denote as QF, and the F stands for failure. We're failing to reach our market equilibrium. We're failing to reach an efficient solution, so I'm calling it the quantity at market failure. Later on in the term, we're going to be doing market projects that are going to be analyzing whether or not there's market failures in specific markets and things like that. So this is something to keep in mind throughout the entire course. So we now know that there's only going to be 8,000 units available. The reason why we use the QS equation and not the QD equation is because a price ceiling that's below equilibrium crosses the supply curve first. If we have a price floor, a minimum price that is above equilibrium, we're going to have the same result. So if we have a price floor that's below equilibrium, nothing changes. We just end up at equilibrium because the level of the price is above the floor. Now, if the floor is above market equilibrium, then we can't get below that floor. Then we're going to have the same problem where we're basically going to have a market failure and there's going to be a smaller quantity than was available at market equilibrium. If that's the case, then the demand curve, the QD equation, would actually dictate the new quantity due to the fact that the demand curve is the curve that's intersected first when we kind of intersect the graph with that price floor. So in this case, quantity supplied is going to be the determinant of QF, which is going to be 8,000 in this context. So with that information, we know what the price is, we know what the quantity is. The question now is how is economic surplus going to be affected by this? So we can calculate economic surplus or consumer and producer surplus individually again with the same equation as before, but instead we might end up with trapezoids instead of triangles, so then we'd have to have a new equation and have to interpret that equation, and things get messy. So instead what we can do, so again, this just goes to show you that what I did on the previous slide, that basically our new QF, our quantity, is going to be 8,000. Instead of calculating those consumer and producer surpluses, what we can instead calculate is what's known as deadweight loss, or DWL for short. Deadweight loss is the loss in economic surplus from failing to reach market equilibrium. So when we have a price floor that's not being achieved, a price floor that's preventing us from achieving equilibrium, then the demand curve is going to dictate QF. But if we have a price ceiling that is preventing us from achieving equilibrium, then QS is going to determine QF if we're using equations. If it's visible on the graph, I mean, it's still going to be QS, quantity supplied, but if you can determine specifically from the graph, great. But if you can't, then you might have to use the equations as I'm showing you. But basically, deadweight loss is combining consumer and producer surplus. So consumer surplus and producer surplus combined are economic surplus. Deadweight loss is saying how much overall economic surplus are we losing from that market equilibrium because we can't get to it. So that's what we're going to calculate. Instead of recalculating and recalibrating the economic surpluses, we could have calculated consumer and producer surplus at market equilibrium, and you could do that on your own if you'd like. But generally speaking, we could just calculate the deadweight loss because that shows us how much surplus we're losing from what was maximized at that equilibrium point. So this equation is a little messy, so that's why I've kind of given you a bunch of descriptors here. So Q star is market equilibrium quantity, just like it always has been. QF is the quantity that we calculated. So before, remember, Q star was 13,000 units, and QF is calculated to be 8,000 units. PD and PS are going to be found in the graph, so let me draw you a hypothetical graph right here. So we have our demand curve here, and we have our supply curve here. Basically, wherever the price ceiling intersects the supply curve, that's going to be PS in terms of a price ceiling that's failing to reach equilibrium. We know what the quantity is here is QF. but PD is going to be the price that corresponds with the demand curve at that Q point. So the difference between here and here is what this is. So you will always know what one of those is, because in the case of a price ceiling that's preventing us from achieving equilibrium, PS is just the price ceiling price. If we have a price floor that's preventing us from achieving equilibrium, then PD is going to be the price floor price. So all you need to do is find the other one. So sometimes you'll be able to tell from the graph. Other times you'll just have to plug that QF into the equation. So in this case, like because this graph I can't tell what anything is, we could take that QD equation, which is negative 10p plus 30,000. So negative 10p plus 30,000. And we can solve for p by calculating and setting it equal to 8,000, because that's what QF is. So Q is going to be 8,000, and now we just have to solve for p. So I've done the calculation already, and I've determined that PD is 2,200. So basically you take that 30K, subtract the 8K from it, you end up with 22,000, divide by 10, you get 2,200. So PD in this example is 2,200. That's basically saying how many units or how much they could sell the actual unit for at that smaller quantity. And so really, what is deadweight loss? Deadweight loss, what we're calculating is really this triangle right here. Before at market equilibrium, that was captured within economic surplus. But since we aren't there anymore, we're stuck at this quantity. This quantity is never produced and sold. And so as a result, this is deadweight loss, and we calculate it to be the loss in economic surplus. Oh my goodness, let me fix that so it actually looks visible, legible. There, DWL. So, our unknowns. Market equilibrium quantity, we knew that. QF we solved, it's 8K. PS is just the price ceiling, so it's 1,200. And PD is just basically going to be that price of theirs, which is 2,200. So we plug all that in, we get 5,000 times 1,000 times a half, which ends up being a half times 5 million, which means that our deadweight loss is $2.5 million. So there's a loss in welfare and economic surplus of $2.5 million because of this price ceiling implemented. So the question you might be asking is, why would we do this? The reason why we would do this is because of the fact that the government has decided that the efficient solution, the market equilibrium solution, is too expensive and it's pricing people out of the community. And in order to promote a diverse kind of spanning different socioeconomic classes and ethnicities and cultures, they have decided that it's worth the trade-off to have more equitable prices for housing than to just basically sell it off to the highest bidder. And so that's up for public debate. So again, clearly it's less efficient to impose a price ceiling or a price floor, but it's up to society to figure out whether or not equity wins the day or efficiency wins the day. So here's another example. We have the market for Oreo cookies. So if we just use the graph, we can determine that our market equilibrium is going to be at $4 and at 250,000 boxes of Oreos. So P star is equal to $4. Q star is 250,000 boxes of Oreos. So we've already answered the first part. Q star is 250K. Now, if the government imposed a price floor of 370, so if they impose a price floor of 370, that means we can't go below this price. But equilibrium's already at $4, so nothing is going to happen here. But what if we impose that price floor of $4.30? We can't charge anything less than $4.30. Well, that's going to cause a problem. that price floor is preventing us from getting to equilibrium. So again, if we wanted to find Q sub F, it's going to be determined by the demand curve this time, not the supply curve, because that's what's intersecting first. So we're going to go down here, and our QF is now going to be 50,000. Our price is $4.30 because we can't charge less than that, and we can't achieve our equilibrium. Now, if we do this, this is our QF line right here. This whole triangle here is now going to be our deadweight loss. It's a pretty big triangle. We're losing 200,000 units because we're going from Q star, which is 250K, to QF, which is 50K. So we're losing 200,000 boxes. Now the difference between PD and PS is the other half of this equation, which is just PD is just going to be the price floor, which is 4.3 minus 3.4, because that's where this intersects this is where the supply curve intersects QF line. So 3.4. So we plug all that in, we end up with 0.9 times 200,000, which is 180,000. But we have to divide that by 2 because it's a half, because it's a triangle. So our deadweight loss in this example is going to be $90,000. So the market, because we couldn't achieve equilibrium, has lost $90,000 of economic surplus. So this just shows you the answers. We could have calculated consumer and producer surplus. You could do this on your own. Notice how they're not the same here. They don't necessarily have to be the same. In fact, most of the time they aren't the same, and they probably shouldn't be the same. And then here I calculated our QF and our price and our deadweight loss, as I've showed before you in messy finger drawing, $90,000. So let's talk about taxes for a little bit. So in terms of taxes, the government might impose a tax to try to further a goal. Maybe they're trying to raise revenues, maybe they're trying to deter bad behavior. Whatever the reason, it's going to have some sort of burden. So taxes can be imposed either on the buyer or the seller. Most of the time they're imposed on the seller, and then basically they are liable for paying the tax to the government. If it was imposed on us, then basically we would just pay whatever we pay, and then at the end of the year we would be subject to a tax bill, and then we would have to pay that out of pocket. So rather than pay it all at once, we usually impose it on the seller, and then they collect it, and then they pay it periodically. And then we pay it periodically every time we make a purchase. If it's a sales tax, depends on if there's a sales tax on a specific product or if you're in a specific state. So Montana and Oregon don't have sales taxes. Wyoming doesn't have sales tax on groceries, and Michigan has sales tax on everything. Ohio doesn't have sales tax on food, but it has sales tax on everything else, except for this tax-free weekend that occurs at the beginning of the school year, where basically some clothes and school supplies are considered sales tax-free. Then you have property taxes and income taxes and things like that. But anyways, the tax incidence is basically the share of the tax that is borne by the buyer and the seller respectively. And then if there's an inefficiency created by the tax, which and when we talk about externalities, it actually cures some inefficiencies. But if there's deadweight loss that's created, we consider it the excess burden. So here's an example of a tax being imposed at the gas pump. So we're going to impose this 10 cents per gallon tax on the seller. So when we talked about supply last lecture, we talked about costs of inputs. We can treat a tax, a 10 cents per gallon tax, as an input for the firm. It's a cost imposed on the firm. And so as a result, their supply curve is going to shift left. There's going to be a decrease in supply as a result of an increased cost, and we're going to move from S1 to S2. The demand curve is going to remain the same, but the supply curve is going to shift up. So now we have a new equilibrium. Originally it was at $3.50 per gallon, but now it's at $3.58 per gallon. However, the actual amount that the firm is actually going to receive in that gas is not $3.58, but $3.48. The reason being is because after that new equilibrium was determined, they also have to take 10 cents off the top and pass it to the government. So actually what ends up happening is that the household ends up paying 8 cents or 80% of the tax. So that's their tax incidence is 80%. And then the firm basically loses 2 cents in revenue from the tax, so they end up paying 20% of the tax. So their tax incidence is 20 cents. Also notice that the new equilibrium quantity is smaller. It's 4 billion fewer gallons. And so this little triangle that's down here is our deadweight loss. That's our tax burden. That's our excess burden. Our excess burden is there. The tax incidence is distributed 80-20, so 80% to consumers, 20% to firms. Deadweight loss is this. And then the reduction in production is actually 4 billion gallons from this increased tax. Now, if we impose it on consumers, on the other hand, then what ends up happening is it's going to affect the demand curve. So the supply remains constant, but if we have to now pay an extra 10 cents per gallon at the pump, then basically our demand is going to shift to the left and decrease to that relative level. And remember, we have to end up paying an extra 10 cents at the end. So what ends up happening is we actually end up paying 10 cents more than what our equilibrium point is with the supply curve. So because we are having to pay this extra 10 cents, we're less willing to pay and produce at a certain level or consume at a certain level. So we end up shifting back, and we notice that this new equilibrium is now at $3.48. So that what ends up happening is the firm is now receiving their $3.48 and they're charging $3.48, but that tax is now going to be collected, so we have to pay an extra 10 cents, so we actually end up paying $3.58 at the tank, and then we end up, so essentially the firm is again paying 20%, households are paying 80%, so even though it's being imposed on us instead of the seller, in both cases we end up paying 80%. So in almost all cases, whether we pass it on to the seller or the buyer, we as consumers end up paying for the tax in the long run. And then again, deadweight loss is the same. Right here's our deadweight loss, also known as excess burden. And then the tax incidence is 80% for consumers, 20% for firms. So again, just to show you, the excess burden apparently is going to be $3.7 billion in this specific example for cigarette consumption. Again, this one was passed on to the seller, so the seller's supply curve shifts to the left because of the increased cost. Then basically what ends up happening is now the equilibrium is going to be at $5.90. There's a reduction in cigarette production of 300 million units. The tax revenue is going to be indicated by that green area there because it's just $1 per pack times however many packs are sold. So $3.7 billion right there. And then notice that the tax incidence is going to end up being 90% to the consumer and 10% to the house or to the firm, because the firm is now receiving 10 cents fewer per pack, but the cost of the pack is now 90 cents higher. So that means that the consumer is now paying 90 cents extra. So 90% of the tax incidence goes to the consumer, and then 10% goes to the firm. So no matter what, it seems like consumers are always going to be paying this tax, and in a way, maybe if it's trying to curtail cigarette consumption, then maybe that isn't a bad thing necessarily, but that's up to the public and that's up to individuals making their own choices. And then that deadweight loss is not 3.7 billion. The actual revenue is 3.7 billion, excuse me, from before. And then the deadweight loss is just going to be that area right there, which I don't necessarily think I can calculate right off the top of my head. It's actually $1 times 300 million divided by 2, assuming that's a triangle. So we're going to have, we're going to have $1 times, so 300 million divided by 2, so $150 million is actually going to be the excess burden in this example. So using those mathematical equations, we can calculate a bunch of information. We can also use the graphs like we did in the Oreo example to do those calculations. It's important to know how to do it in all ways because it allows for you to be more versatile and have more information and to solve things in a more concise and kind of more versatile way. So that concludes this lecture. Again, please feel free to contact me if you have any questions or concerns or need any help with explanation and any of the concepts. And good luck on your assignments, quizzes, exams, and any other classwork that you may have.